you checked YouTube Live? Is it okay? Hmm? Yeah, hello, guys. Today, welcome to our webinar today, the Guru Trader 2. And if you all had made it down from the beginning, where we started the financial market literacy, made it down to Forex Anatomy 1 and 2. And now we are in the Guru Trader 2. We had Guru Trader 1 last week, and it was a blast. And today, we are looking at more in-depth discussions about the financial market, the Guru Trader 2. Now, we'll be talking about economic jargons, fundamental analysis. We'll be talking about fundamental factors that also affect currency values. And also, finally, we'll be speaking about market expectations to news and their impacts on various currencies. Now, it's ideal that you follow through. If you haven't been following through from the inception, you can pick up back on our YouTube live videos. Sorry, YouTube recorded videos on YouTube to match the expectations and to also meet up with what we have been talking about. Now, today on Guru Trader 2, we'll be explaining a lot about fundamental analysis, economic events, what actually moved them, etc., etc. So fasten your seatbelts and enjoy the ride. Let's go, please. Next page. And today we are looking at fundamental analysis. First, we are talking about significant economic events that happens that actually move the markets, that drive the market forces, and how to make money with them, which is, of course, very ideal. Fundamental analysis is the use and study of these factors to forecast future price movements of currencies. And as expected, we're going to be focusing on different currencies. The major, of course, United States dollars. We'll be having a look at the euros, Japanese yen, the Great British pounds, and the rest of them like that. So now, for instance, whenever you hear people mention fundamentals, they are more or less talking about economic fundamentals of a currency's host country or economy. And economic fundamentals also cover a vast collection of information, whether it is in the form of economic, political, or environmental reports. And of course, these data and announcements, as well as events, move the markets. So it's just like you having an understanding that the United States dollar is actually doing well at this point in time. And of course, it reflects on how the economy has been performing very well. And we're already giving you a tease about fundamental analysis during our at the beginning of the Forex market financial literacy. Now we need to get that deep down into every details you need to know about how to analyze different countries' economy, how it affects the market, how it should affect your trading too as well, and so much more to learn. Next page, please. Now, in particular, we are talking about fundamental analysis, providing insights into how the price action should or may react to certain economic events. Now, fundamental data takes shapes in different forms. It can appear in form of a report by the Fed. You know, they have different names to it. US existing home sales, performance index, and a lot of them like that. So it can also exist in possibility that the European Central Bank will change its monetary policy. Now, usually the release of this data to the public often changes the economic landscape, or better yet, the economic mindset. Now, creating a reaction from investors and speculators There are even more instances where no specific report might have been released, but the anticipation of such a report happening is, on the other hand, an example of fundamentals. Speculations of interest rate hikes can be priced in hours or even days before the actual interest rate statement would happen. Now, in fact, currency pairs have been known to sometimes move 100 pips just moments before major economic news events happen, making them a profitable strategy for both seasoned traders and short-term traders, or whatever kind of trader you might be, to make a lot of profits from the financial markets. To the next page, please. Now, generally, economic indicators make up a large portion of data using fundamental analysis. For instance, you have a fire alarm sounding that detects smoke or feels heat. Economic indicators provide some insight into how well a country's economy is doing. Yeah, why it's important to know the numerical value of an indicator. Equally as important is the market's anticipation and prediction of that value. So understanding the resulting impact of the actual figure in relation to the forecasted figure is the most important part. These factors all need consideration when deciding to trade. You don't need to worry about all these things. It's simpler than it sounds, and you would need to know. You don't need to know rocket science or the y, the x, or something difficult to figure it out. Fundamental analysis is purely easy. It's a valuable tool. It estimates the future conditions of an economy, but not so much for predicting the currency's price direction. And of course, this type of analysis has a lot of gray areas because fundamental information in the form of reports, releases, or monetary policy change announcements is vaguer than actual technical indicators. And the analysis of economic releases and reports of fundamental data usually goes something like this, like an interest rate increase of that percentage may cause the euro to go up. Now, the United States dollar should go down with an indicator value in that range. We have consumer confidence that dips 2% since the last report. To the next page, please. Now, for instance, when you have an economic report, the market has a tendency to react based on how people feel, which is speculations, of course. I always tell people the market is about 75% based on speculations because we have a lot of traders in different countries, in India, traders in China, traders in Kenya, traders all around the world, and their feelings and the emotions when they click on the buy or the sell button is what reflects on the chart. Now, these feelings can be based on their reaction to economic reports, based on their assessment of current market conditions. And as you have guessed, there are tons of people, all with different feelings and ideas. You're probably thinking, what could be the certainty that this market is going to move this way? You can't really say for sure. It might move to the left, it might move to the right. You are depending on how different traders from different regions usually see this. So there's no way of knowing 100 a country currency pair will go because of some fundamental data. That's not saying that the fundamental analysis should be dismissed, of course, because it's very vital. It's very vital for us to focus on fundamental analysis. Next page, please. Now, as a result of the sheer volume of fundamentals and the fundamental data is available, most people simply have a hard time putting it all together. They understand a specific report, but they can't factor it into the broader economic picture. This simply takes time and a deeper understanding of the market data, of course. Now, also, since we have most fundamental data reported only for a single currency, we have fundamental data for the other currency in the pair would also be needed and would then have to be compared to get an accurate picture. But if you're too busy to go through a bajillion news reports and economic data, you don't need to be scared of that. Your resident economic guru, Nicholas, can get you covered. Make sure you follow through everything that we have been talking about from inception, and you'll be right on track with us, making consistent profits. And at this point, you're probably waiting to hear the answer. Will I ever need to fully understand fundamental analysis to become a successful Forex trader? We totally understand that there are two sides to it, because one, you have to be fully grounded in fundamentals, and also you need to understand the technicalities that are involved in the chart to know when the charts are really going to have a very ballistic upward move or very unpredictable downward move. So technical analysis comes in hand to be preferred, and the methodology of short-term Forex traders should have the idea with price action on their main focus, because intermediate or medium, let's say medium traders and some long-term traders like to focus on fundamental analysis too, because it helps with currency valuation. So all these things are very ideal when you're taking into consideration how your trading game should be. To the next page, please. Yes, of course, technicals are so much important as fundamentals. We like to be a little bit crazy by saying that you should use the both, of course, because technical strategies are blown to bits when a key fundamental event occurs. And in the same respect, pure fundamental traders miss out on the short-term opportunities that pattern formations and technical levels bring. Now, a mix of technical and fundamental analysis, here's how it goes. It covers all angles. You're aware of the scheduled economic releases and events, but you can also identify and use the various technical tools and patterns that market players usually focus on. Now, take for instance, you have a couple of trade examples for you showing how the perfect blend of fundamental and technical analysis results in massive profits. Now, in this lecture, we'll be discussing major fundamental factors that usually affect currencies, interest rates, monetary policies, and market moving economies, reports, etc., etc. Next page, please. Why do interest rates matter for Forex traders? Simply put, interest rates, let's say they make the Forex world go round. In other words, the Forex market is ruled by interest rates. A currency's interest rate is probably the biggest factor in determining the perceived value of a currency. Now, you're knowing how a country's central bank sets its monetary policy, such as interest rate decisions, is a crucial thing to wrap your head around, because one of the biggest influences on a central bank's interest rate decision is what we call the price stability, also inflation. Price stability and inflation is the steady increase in the prices of goods and services. Inflation is one of the main reasons why people pay a little money, and now people pay 2 times the money of what they usually paid in the past. Your parents usually paid maybe a couple of bucks for soda in the past, but now it's double or triple the prices. And this is as a result of inflation. It's generally accepted that moderate inflation comes with economic growth. So, however, too much inflation can harm an economy, and that's why central banks are always keeping a watchful eye on inflation-related economic indicators, such as the CPI, the Consumer Price Index, and PCE, Producer Consumer Expectation. Now, to the next page, please. Yep. Now, we'll be taking a look at some countries and very important bodies, fundamental bodies that guide their inflation and everything that's resulting to their economic performance. Now, we're taking a look at Australia. We're talking about Reserve Bank of Australia, RBA. We look at Canada, BOC, Bank of Canada. We're looking at the European Union, ECB, European Central Bank. Take a look at Japan, Bank of Japan, BOJ. We're looking at New Zealand, Reserve Bank of New Zealand, RBNZ. We look at Switzerland, Swiss National Bank, SNB. We're looking at United Kingdom, BOE, Bank of England, and we're looking at United States, the Federal Reserve. So in an effort to keep inflation at a very comfortable level, central banks will most likely increase their interest rates, resulting in a lower overall growth and slower inflation, as the case may be. To the next page, please. Now, we're talking about interest rate hike, similarly interest rate cut. Now, we have lower economic growth, slower inflation when it comes to interest rate hike. And also we have faster inflation, higher economic growth when it comes to the interest rate cut. Now, this of course occurs because you're more or less setting high interest rates, normally which forces consumers and businesses to more or less borrow less and save more, putting a damper on economic activity. Loans just become more expensive while sitting on cash becomes more attractive. Now, on the other hand, when interest rates are decreasing, consumers and businesses are more inclined to borrow because banks ease lending requirements, boosting retail and capital spending, thereby helping the economy to grow, as the case may be. Next page, please. You might be wondering, what does this have to do with the Forex market? Generally, currencies rely on what we call interest rate because this obviously dictates the flow of global capital in and out of a country, and they are what investors use to determine if they will actually invest in a country or go elsewhere. Now, take for instance, if you had your choice between a savings account offering 1% interest and another offering 25%, which would you choose? Neither you say, yeah, we are inclined to go with the same route, keep the money under the mattress, you know what you mean, but that's not exactly the option. The higher a country's interest rate, the more likely its currency will strengthen. Currencies surrounded by lower interest rates are more likely to weaken over the longer term. It's pretty simple stuff. The main point to be learned here, to be understood here, is that domestic interest rates directly affect how global market players feel about a currency's value relative to another. To the next page, please. Now, what are the interest rate expectations? Market makers are ever changing with the anticipation of different events and situations. Now, interest rates do exactly the same thing. They change, but they definitely don't change as often. Most Forex traders don't spend their time focused on current interest rate because the market has already priced them into currency prices. Which is more important is where the interest rate are expected to go. It is also important to know that interest rates tend to shift its line with our monetary policy, or more specifically, with the end of monetary cycles. If rates have been going a bit lower and lower over a period of time, it's almost inevitable that the opposite will happen. Rates will have to increase at some point, and you can count on the speculators to try to figure out when they will happen and by how much they are going to happen. The market will tell them it's the nature of the beast. A shift in expectation is the signal that a shift in speculation will obviously start gaining more momentum as the interest rate changes nears. While interest rates change with the gradual shift of monetary policy, market sentiments can also change rather suddenly from just a single report. Now, this causes interest rates to change in a more drastic fashion or even in the opposite direction as originally anticipated. So you need to be on the key watch out for this. Next page, please. Interest rate differentials. Pick a pair in your mind, any pair. Now, many Forex traders use a very viable technique of comparing one currency's interest rate to another currency's interest rate on the starting point for deciding whether a currency may weaken or strengthen. The difference between the two interest rates, known as the interest rate differential, is the key value. to keep an eye on this spread can, to keep an eye on this, the spread can, help you identify shifts in currencies that may be quite obvious, and an interest rate differential that increases helps to reinforce the higher yielding currency, while a narrow flowing differential is, positive for the lower yielding currency. Instances do come up where the interest rates of the two countries move in opposite directions, often produce some of the market's largest swing. Now, an interest rate increase in one currency combined with the interest rate decrease of the other currency is a perfect equation for sharp swings. Always do note this. Next page, please. Nominal versus real interest rates. When people talk about interest rates, they are, either referring to the nominal interest rate or the real interest rate. You might be wondering what's the difference. The nominal interest rates are, they don't always tell the entire story. The nominal interest rate is the rate of interest before adjustments for inflation. Now, let's have a simple understanding of this. Real interest rate is just the simple difference between the nominal interest rate and the expected inflation. Now, the nominal rate is usually the stated or base rate that you see. For example, the yield on a bond. Markets, on the other hand, don't focus on this rate, or rather on the real interest rate, they do focus on it. Now, if you have a bond that carried a nominal yield of 6%, but the inflation was at an annual rate of, let's say, about 5%, the bond's yield would just, keep yielding and would be like 1%. And of course, that's a huge difference because you always remember to distinguish between the two. Never forget to distinguish between the two. Next page, please. How do monetary policy affect the Forex market? Quite simple with this. As we had mentioned earlier, national governments and their corresponding central banking authorities formulate the monetary policy to achieve certain economic mandates or goals. Now, central banks and monetary policy go hand in hand. So you can talk about one without talking, you can talk about one without talking about the other. While some of these mandates and goals are quite similar between the world central banks, each of them quite have their own unique set of goals brought on by their distinctive economies. And ultimately, monetary policy boils down to promoting and maintaining price stability and economic growth. Now, to achieve their goals, central banks usually have what we call monetary policy, mainly to control the following things: the rise in inflation, the money supply, the interest rates tied to the cost of economy, and reserve requirements over banks. Also, discount window lending to commercial banks, which of course is one of the major things. Next page, please. Types of monetary policies. We can understand monetary policies, they can be referred to in a couple of different ways. Contractionary or restrictive monetary policies, they usually take place if it reduces the size of the money supply. It can also occur with the raising of interest rates. The idea here is to slow down the economic growth with the high interest rates. Borrowing money becomes a bit harder and more expensive, which usually reduces spending and investment by both consumers and businesses, right? Expansionary monetary policy, on the other hand, expands or increases the money supply, or let's say decreases the interest rate, while the cost of borrowing money goes down in hopes that spending and investment will go up. Next page, please. Accommodative monetary policy aims to create economic growth by lowering the interest rate, whereas tight monetary policy is set to reduce inflation or restrain economic growth by raising interest rates. Finally, neutral monetary policy intends to, neither create growth nor fight inflation. the important thing is to remember about inflation is that central banks usually have an inflation target in mind. Let's say about 2%, and they might come out and say it specifically, but their monetary policies all operate and focus on reaching the comfort zone, which is most important. Now, they know that some inflation is a good thing, but out of control inflation can remove the confidence people have in their economy, in their job, and ultimately in their money, right? Next page, please. By having target inflation levels, central banks help market participants better understand how they control the central bankers will deal with the current economic landscape. Let's take a look at an example. Back in January, then 2021, 2010, sorry, inflation in the UK shot up to 3.5% from 2.9% in just 1 month, with a target inflation rate of 2%. The new 3.5% rate was well above the Bank of England's comfort zone. Mervyn King, the governor of the Bank of England, followed up by the report by reassuring people that temporary factors caused the sudden jump, and that the inflation rate will fall in the near term with minimal action from the BOE. Whether or not his statements turned out to be true is not the point here. We just want to show that the market is in a better place when it knows why the central bank does or doesn't do something in relation to its target interest rate. Simply put, traders like stability, central banks like stability, and economies like stability. Knowing that inflation targets exist will actually help the trader to understand why a central bank does what he does. To the next page, please. Round and round with monetary policy cycles. For those of you that follow the US dollar and economy, and that should be all of you, of course. Remember a few years back when the Fed increased the interest rates by 10% out of the blues, it was the craziest thing to come out of the Fed, of course, and the financial world was in a sort of opera. It was like all over the media, and petroleum prices went up, same as the price of gold, and just the idea of something like that happening would obviously disrupt not only the individual trader, but the economy as a whole. And that's why we normally see interest rate changes of 0.2.5%, so 0.25% to 1% at a time. And again, remember that central banks want price stability, not shock and awe. And part of this stability comes with the amount of time needed to make these interest rate changes happen. It can take several months to even several years for these things to happen. Okay. Next page, please. Now, just like Forex traders who do collect and study data to make their next move, central bankers do a similar job, but they have to focus their decision-making with the entire economy in mind, not just a single trade. Interest rate hikes can be like stepping on the brakes, while interest rate cuts can be like hitting the accelerator. But bear in mind that consumers and businesses react a little more slowly to these changes. Now, this lag time between the change in monetary policy and the actual effect on the economy can take 1 to 2 years. Yeah, approximately 1 to 2 years before it can be recovered. Next page, please. Hawkish and dovish central banks. Very interesting. Now, central banks operate like most other businesses in that they have a leader, a president or chairman. It's that individual's role to be the voice of that central bank, conveying to the market which direction monetary policy is actually headed. Now, and much like when Jeff Bezos or Mark Zuckerberg steps into the microphone everyone pays attention, which influence monetary policies. We should understand that interest rates are ultimately affected by central banks' view on the economy's price stability. Now, Zuckerberg, you haven't, for instance, you're using a Pythagoras theorem where A2 plus B2 equals C2. It would make a whole lot of sense to keep an eye on what those guys are saying as the central banks is operating? Because using the complex conjugate root theorem, the answer is yes, of course. Yes, it's important to know what's coming down the road regarding potential monetary policy changes. And lucky for you, central banks are getting better at communicating with the market. Whether you actually understand what they're saying, well, it's a different story, a different ballgame entirely. Next page, please. So, my friends, the next time you're giving speeches, you keep your ears open. Better yet, use all of our videos, trainings about central banks, economic calendars to prepare yourself before the actual speech happens. Because central bank chairman isn't the only one making monetary policy decisions for a country or economy. Whatever they say, it's only not ignored, but it's revered like the gospel. Maybe it might be a bit dramatic at the point of the announcement, but not all central bank officials carry the same weight. You should understand this. Central bank speeches have a way of inciting and exciting the market response. So you watch for quick movement following an announcement. Speeches can include anything from changes, increases, decreases, or holds to current interest rates, to discussions about economic growth measurements and outlooks, to monetary policy announcements outlining current and future changes. But don't despair if you can tune into the live event. As soon as the speech or announcement hints the airwaves, new agencies from all over make the information available to the public, and of course to traders who want to make quick money or take advantage of what the news has given to them. To the next page, please. Still on hawkish versus dovish central banks. Now, rate hike, rate cuts. Hawkish, of course, rate hike. Hawkish, rate cut. Dovish, rate hikes. And you might want to find a banker on the fence exhibiting both hawkish and dovish tendencies. However, true colors tend to shine when there are extreme market conditions occur. Now, we really just meant hawks versus doves, central bank hawks versus central bank doves. That is, central bankers can be viewed as either hawkish or dovish, depending on how they approach certain economic situations. Now, central bankers are described as hawkish when they're in support of raising of interest rates to fight inflation, even to the detriment of economic growth and employment. For example, we have the Bank of England suggesting the existence of a threat of high inflation. Now, the Bank of England could be described as being hawkish if they made an official statement leaning towards the increasing of interest rates to reduce high inflation. Yeah. Now, dovish central bankers, on the other hand, they generally favor economic growth and employment over tightening interest rates. Now, they also tend to have a more non-aggressive stance or viewpoint regarding, the specific economic event or action in place. Right? To the next page, please. With all that due said and done, fundamental factors that affect currency values, there are several of them, several fundamental factors that help shape the long-term strength or weakness of the major currencies, and will also affect you as a forex trader. We have included what we think are the most important for your reading pleasure. One, we have economic growth and outlook. You start easy with the economic outlook held by consumers, businesses, and governments. It's quite easy to understand that when consumers perceive a strong economy, they feel quite happy and safe, and they spend money. Companies willing to take this money and say, "Hey, we're making money. Wonderful. Now, what do we do with all this money?" Companies with money spend money, and all this creates some healthy tax revenue for the government, and they jump on board and also start spending money. Now, everybody is spending. And this, of course, tends to have a positive effect on the economic. And weak economies, on the other hand, are usually accompanied by consumers who aren't spending, businesses who aren't making any money and aren't spending. So the government is the only one still spending. But you get the idea, both positive and negative economic outlooks can have a direct effect on the currency markets flowing. Yeah. Next page, please. Capital flows. Globalization, technology advances, and the internet have all contributed to the ease of investing your money virtually anywhere in the world. Regardless of where you call home, you're only a few clicks of the mouse away or a phone call. For you folks living in the Jurassic era of the 2000s and from investing in New York or London Stock Exchange, trading the Nikkei or Hang Seng Index, or from opening a forex account to trade US dollars, euros, yen, and even exotic currencies. Now, capital flows measure the amount of money flowing into and out of a country or economy because of capital investment, purchasing and selling. Now, the important thing you want to keep track of is capital flow balance, which can be positive or negative. When a country has a positive capital flow balance, foreign investments coming into the country are greater than investments heading out of the country. Now, a negative capital flow balance is the direct opposite. Investments leaving the country for some foreign destinations are greater than investments coming in. With more investment coming into a country, the demand increases for that country's currency, or foreign investors have to sell the currency in order to buy the local currency. Now, this demand is what usually causes the country or the currency to increase in value. Right. Next page, please. Very, very importantly, trade flows and trade balance. Been waiting for this. Now, we are living in a global marketplace. Yeah, we're living in a global marketplace. Countries sell their own goods to countries that want them to, to export, while at the same time buying goods they want from other countries, which is important. Now, you have a look around your house. Most of the stuff, electronics, clothing, dirty toys, a lot of things lying around are probably made outside of the country you live in. But every time you buy something, you have to give up some of your hard-earned cash. Whoever you buy your widget from has to do the same thing. US importers exchange money with Chinese exporters when they buy these goods, and Chinese imports exchange money with European exporters when they buy goods, of course. Now, all this buying and selling is accompanied by the exchange of money, which in turn changes the flow of currency in and out of a country. The next page, please. Trade balance, or let's say balance of trade or net exports, they usually measure the ratio of exports to imports of a given economy. It demonstrates the demand of that country's goods and services, and ultimately its currency as well. Its exports are higher than imports. A trade surplus exists and the trade balance is quite positive, especially if the imports are a bit higher than the exports. The trade deficit exists and the trade balance is negative, of course. Now, exports greater than imports equals trade surplus, which equals positive plus trade balance. But then imports greater than exports equals trade deficit, which equals negative minus trade balance. I hope this is clear. It's just quite simple. Exports greater than imports equals trade surplus, which equals positive plus trade balance, while imports greater than exports equals trade deficit, which equals negative minus trade balance. It's all part of the economic jargon, but it's very vital you understand this. Next page, please. Now, the government, present and future. The years 2009 and 2010 had definitely been the years where money eyes were glaringly watching their respective countries' governments, wondering about the financial difficulties being faced and hoping for some sort of fiscal responsibility that would end the woes felt in our wallets. Now, instability in the country, in the current government, or changes to the current administration can have a direct bearing on that country's economy and even neighboring nations. And a very strong impact to an economy will most likely affect exchange rates. Now, where to find this forex news and market data? We have a quick Yahoo Gling, we have Yahoo, Google, plus Bing. A lot of them like their forex news, investing.com. So many of them, TradingView. With returns measly about 30 million results combined. 30 million is a whole lot. No wonder you have to get some education, because there's just too much information to try to process and way too many things to confuse any newbie forex trader. That's some insane information overload if we have ever seen that before. But information is equally king, very vital when it comes to making successful trades. Now, currency prices moves because of all of this information: economic reports, a new central bank chairperson, interest rate changes, inflation changes, etc., etc. Next page, please. Where do we find forex market news and market data? Now, market news and data are available through a multitude of sources. The internet is the obvious winner in our book, as it provides a wealth of options at the speed of light, directly to your screen, of course, with access from almost anywhere in the world. But don't forget about the print media and a good old tube sitting in your living room or kitchen. Now, individual forex traders will be amazed at the sheer number of currency-specific websites, services, and TV programming available to them, because most of them are free of charge, while you may have to pay for some of the others. Let's go over our favorites to help you really understand. One, traditional financial news sources. Yeah, Reuters, the Wall Street Journal, Bloomberg, very important, Bloomberg, MarketWatch.com. So these are very big names. These guys provide around-the-clock coverage of the markets with daily updates on the big news that you need to be aware of, such as central bank announcements, economic report releases and analysis. Have institutional contacts that provide inflations about the current events of the day to the viewing public. To the next page, please. Real-time feeds. If you're looking for more immediate access to the movements in the currency market, don't forget about the 80-inch flat screen TV in your bedroom. Now, financial TV networks exist 24 hours a day, 7 days a week, to give you an up-to-date, up-to-minute, up-to-second action on all the world's financial markets. In the US, the top dogs are in random order: Bloomberg TV for business, CNBC, MSNBC, and even CNN. You could even throw a little BBC in there. Another option for real-time data comes from your forex trading platform. Many forex brokers include live news feeds directly in their software to give you easy and immediate access to events and news of the currency market. Yeah. Now, you have to check your broker for availability of such features. Not all brokers' features are created to have this, of course, but Ztradex, we have this. Next page, please. Economic calendars, very importantly. Let's say what rate, for instance, what rate is forecasted, what rate actually occurs, and what type of impact this change has on the currency market. It's all possible with an economic calendar, that's the truth, because the good ones let you look at different months and years, let you sort by currency, let you assign your local time zone. 3 p.m. where you are sitting isn't necessarily 3 p.m., but where we are sitting, so make use of the time zone feature so that you are ready for the next calendar event. Yes, economic events and data reports take place more frequently than most people can keep with. This data has the potential to move markets in the short term and accelerate the movement of currency pairs you might be watching, even down to the long term. Now, wouldn't it be great if you could look at the current month and know exactly when the Fed is making an interest rate announcement? Of course, that would be like heaven. Next page, please. Market information tips, very importantly. You also have to be able to determine whether the news you're dealing with is fact or fiction, is rumor or opinions. Now, you keep in mind the timelessness of the reports that you read. You have to understand a lot of this stuff have already occurred, and the market has already, adjusted prices to take the report into account. But if the market has already made its move, you might have to adjust your thinking and current strategy, because you have to keep tabs on just how old this news is, or you find yourself on yesterday's news, of course. Now, economic data rumors do exist, and they can occur minutes to several hours before a scheduled release of data. Now, the rumors help to produce some short-term trader action, and they can sometimes also have a lasting effect on market sentiments. Institutional traders are also often rumored, to be behind large moves, but it's hard to know the truth with a decentralized market like spot forex. Now, just never a simple way of verifying the truth about these things until you make proper market information tips from it. Next page, please. Now, your job as a forex trader, one, is to create a good trading plan and quickly react to such news about rumors. After they have been proven true or false, having a well-rounded risk management plan, in this case, could save you some mola, some funds, greenbacks, cash, whatever you want. And the final tip, of course, know who is reporting the news. Now, are we talking about analysts, economists? Economics are the owner of the newest forex blog on the block, maybe a central bank analyst. The more reading and watching you do of forex news and media, the more finance and currency professionals you'll be exposed to. And they are offering merely an opinion or a stated fact based on recently released data. Now, the more you know about the who, the better off you will be understanding how accurate this news is. Those who report the news often have their own agenda and have their own strengths and weaknesses. Get to know the people they know, so you know. I don't know if you can understand what I mean, but just have the understanding that the better off you will be understanding how accurate the news is. Those who report the news often and how their own agenda and have their own strengths as well as weaknesses. To the next page, please. Real-time feeds. Now, your favorite news personality gets into the mix by surveying their in-house economist, collection of financial sound players in the market. A consensus expectation or just consensus is the relative agreement on upcoming economic or news forecasts. Economic forecasts are made by various leading economists from banks, financial institutions, and other security-related entities. All the forecasts get pulled together and averaged out, and it's part of these averages that appear on charts and calendars designating the level of expectation for that report or for that event. To the next page, please. Now, the consensus becomes ground zero. The incoming or actual data is compared against this baseline number. Incoming data normally gets identified in the following manner. One, as expected, the report data was close to or at the consensus forecast. Now, better than expected, the reported data was better than the consensus forecast, while worse than expected, the reported data was worse than the consensus forecast. Whether or not incoming data meets consensus is an important evaluation for determining price action. Just as important is the determination of how much better or worse the actual data is to the consensus forecast. Larger degrees of inaccuracy increases the chance and extent to which the price may change once the report is out. Now, however, let's not forget that Forex traders are smart and can be ahead of the curve. Now, we're the good ones anyway. Many Forex traders have already priced in consensus expectations into their trading and into the market well before the report is scheduled, let alone being released. But as the name implies, pricing in refers to traders having a view on the outcome of an event and placing bets on it before even the news comes out, which is crazy. Next page, please. Now, it's a bit of a tough one because you can always seem to understand, or rather take it upon yourself to stay on top of what the market commentary is saying and what price action is doing before a report gets released. This will give you an idea as to how much the market has priced in. A lot can happen before a report is released. So you got to keep your eyes and your ears peeled. Market sentiment can improve or get worse just before a release. So you need to be aware that price can react with or against the trend. There is always the possibility that a data report totally misses expectations. So you don't bet the farm away on the expectations of others. When the miss occurs, you'll be sure to see price movement occur. You help yourself out for such an event by anticipating it and other positive possible outcomes to happen. So you play the what if game. Ask yourself, what if A happens? What if B happens? How will traders react to change their bets? You could even be quite more specific. What if the report comes in under expectation by 0.5%? How many pips down will price move? What will need to happen when this report could cause a 40 pip dip? Anything, really. You have to come up with your different scenarios and be prepared to react to the market's reaction. Being proactive in this manner will, keep you ahead of the game. Next page, please. So that's a wrap for today on the Guru Trader 2. I believe you gained valuable information on how to strategize if you're having a losing trade, how to come back, have a winning trade, how to be at your best performance, making raw and undiluted analysis in the financial market. So thanks for your time today, and I'll see you again hopefully next week.